and welcome to the second hour of TheoTRADE. I am Professor Jeffrey Bierman. I am broadcasting you live from Chicago, and today is Wednesday. It is January 14th. It is 2026. Good morning, TheoTRADE members. Good morning. We got 900 in there. We need more. Hello, trains. Tim, how many of you are Genesis Cog members? Come on, scream it out there. Did I pay for your membership for the whole friggin' year today? Today alone pays for your whole membership. We've got basically 15 winners, 15, and they're all going gangbusters vertical, and they're all crashing on the shorts. I told you it's coming. There's always a day of reckoning in this business. All we did was we caught the rotations. We waited for the opportunity for the highest return with the lowest risk. We pounced, and we did great. Backyard Bob, you happy guy, Backyard Bob? You happy, John O'Donnell? Everybody's loving it. Everybody's loving it. We're going to get through today. We're going to get through part 4 of a volatility, the cons, the actual bad part of low volatility stocks. And I got a lot of them. So they're not the answer. They're not going to make you money every time, but there are certain subtle nuances you have to pick up on learning how to trade low vol stocks and not turn it into a diversification vehicle, because a lot of you turn it into a diversification vehicle. We're going to hit on that. But today we're going to run with the theme. But let me say hello to my usual suspects. Hello, Lefty Golfer. Hello, Chris Shore. You're new. Hey, Miguel. Chicago Dave. Trader John. Carlos. Everybody, you guys all happy? You happy, Florida Woody? Did I tell you to trust me? I said, if you trust me, it only takes one day when they flip-flop the market where you pay your whole membership. And today was basically that day. We got a long way to go, Florida Woody. So keep warm there. By the way, in Chicago today, it started out last night at 52 degrees. 52. It's now 22 degrees. We got 3 inches of snow this morning. So driving my daughter to school this morning, she goes to private school, there was no snow. And within seconds, it turned into a whiteout. Literally in 4 seconds, I couldn't see out the mirror of my car. So we are in a whiteout in Chicago. So if my power goes down, forgive me, it's beyond my control. It's the grid in Chicago. Good morning, everybody. All right. So I had this title picked out last night. So when I prepare for today's coaching session, I prepare a day early, and then I hit on things in the day that capture my attention, because my job here is not to dazzle you. My job here is to educate you and get you to learn how to manage risk and build wealth like I've done. So here's the thing. This title came in last night. I had like an epiphany. It's called Breaking the Logjam. Everybody ever heard the term breaking the logjam? I'm sure a lot of you have. Because today we are breaking the logjam, and if you don't get out of this market, you're in big trouble. I can see it coming, people. You know, I don't get paid. I don't get paid behind the curve. You want to trade behind the curve? Fire me. I'm way ahead of the curve on all of you. I see things happening way before they move, because that's what I've been doing for 40 years. I'm a little early on a lot of things, but I'm never late. And I'm telling you right now, we're in what's called breaking the logjam. If you look at the price action over the last 2.5, 3 months, it's been a pure logjam. So let me define what a logjam is. It's defined as a situation, and you can use it metaphorically. So I'm going to use it. Here's a literal description of a logjam. Literal. But you can use it metaphorically. It's defined as a situation where a large number of logs float down a river, becoming tangled and blocking movement. Doesn't that sound like the stock market? Because it sounds like that to me from all the algos that fooled all of you. The algos are going to save me. No, they're not. They're going to destroy you when they reverse this, because the algos only sell into downward slopes. They don't buy. You do. So you have to realize, like, at some point, the game ends. The bull market ends. And if you hang too long to the party, okay, you get absolutely just tail whipped here. And that's what's about to happen. I can see it on my screen. It might take another few weeks. But I said, quote, I said this 6 weeks ago. I said, December is a waste of time. It's manipulated. It's rigged. It's all window dressing. Everything will be bought. I said by the second week of January, second week, I told you things will change dramatically. I don't care about your fundamentals. I'm not interested in your stupid Jerome Powell. We're going down because the law of mathematics says we're going to go down, and now is the time. So this log jam, okay, which is a deadlock or standstill in negotiations or processes where progress is hindered due to conflicting interests or lack of agreement. But to break a log jam, what does it mean to break a log jam? That's where I'm coming from. It means to resolve or change the situation, allowing progress to occur. TheoTRADE members, where have all of you been? Are you going to bite into that stupid garbage that the news media feeds you constantly, that we're going to go to 8,000? We're not. We're going to go down before we go up. If we're going to go up, you got to take off all of the froth, all of the bullishness. You need that VIX at a 35 to 50 to get me to buy this market, or I'm not interested at all. I want fear. I want pain. I want risk off. Totally. Then I'll go buy it for nothing. But what you're seeing here is day one. I remind all of you, I tell this to the Genesis Cog members. And if a lot of you are interested, the mastermind webinar is next Wednesday. So we're going to take an hour and a half in this day to explain to you why all of you should be members. You should be a member of Ghost Prince. You should be a member of Gianni Blake. You should be a member of all of these. But mine is different because mine's based around risk management and machines. So here is the deal, people. This is the algorithmic channel. If you think that this is random, you're absolutely out of your mind. It's rigged. Look at it. The algos are programmed to buy these dips. That is a speed bump. That is an algo channel. Look at it. How can you not see this? It's a pattern recognition. But I keep telling you, if we break, and I told you we're going to break it at some time in the next 2 months. I said it's going to be January or February, but not likely March. I told you it's going to happen. All I said was, if you look at the apex of the triangle, and we're right at the apex of the triangle, I said, when you get to this apex, one of two things is going to happen for guaranteed. Either we're going to explode up or we're going to explode down. We look like we're about to fall off a cliff and blow up, people. Now, you're going to look at me and come back at me and saying, but what did Gianni say? And what did Gory say? Don't care. I'm not interested. All I know is I trade what I see and I trade what the indicators tell me, and they're never wrong. And this is what I'm seeing. The indicators rolling over. What did I say about downward slopes? You cannot buy them. You will blow your account out. Now do you believe me? Are you buying this dip? Why would you buy this dip? You just broke the momentum channel. You are now vulnerable to 6,600. It's going to go there, people. I guarantee it. It may get there in 3 weeks or 3 hours, but it's going to go there because algorithms are based upon these points of what we call pivot points. They're just based on it. We broke it. We're going to test 6,800. We don't hold there. We're down to 66. Get risk off now. Stop with the bullishness. You're fooling yourself. The MACD is never wrong. I keep telling you, go to the weekly MACD. That's the secret sauce. The weekly MACD is breaking down. Look at the setup. Stop thinking about anything. Just look at the setup. That's all I'm telling you. The setup is bearish. It doesn't mean it's going to 4,500. That's not what it means. It means algorithms are reactive. They react to the integrity of the slope of the long-term and short-term indicators. The daily indicator is bearish. The weekly's turning bearish. The intraday's bearish. Why would you buy this? What do you think you're going to accomplish? Are you looking to get about 8 points? You're looking to grab 8 points to lose 300? I'd fire you. Are you out of your mind? You trade to manage risk, and the money will come. You may not make money every day because nobody does, but the long-term traders have one thing in common. We're masters. We're masters at managing risk is what we do. We don't predict hour by hour, second by second. We just look at the setup, we look at the backdrop, and the backdrop is simply bearish. You have gold and you have silver in a massive, massive bubble. Now you've got copper not far behind. You've got wood, you've got lumber, and of course, I bought oil at 52. Nobody wanted it. I told you, cyclical. And now you've got oil playing catch up. So now you've got an inflation bubble. You have the Fed who's now behind the curve. You're in a hiring recession. You have a market that's overvalued in many sectors, including tech, semiconductors, and cyclicals. You've got financials fully priced. Where do you think this is going to go? Do you think this is going to end well? You have all the fundamental reasons to sell, and nobody listens because it ain't run by people. It's run by machines. So the deal I learned from Don is stop asking why. I don't ask why. All I know is by the time we hit down 1,000 points, then, only then, I will find the reason why it's down 1,000. So my goal is get ahead of that curve. Don't be caught on the downside. This is day one of breaking the log jam. You need to start to really scale out of risk. And I mean scale out now. Now, I am long. I'm 50% long. But everything I'm long is going parabolic. Everything. One of my shorts, okay, you can call it luck. Okay, that's one of my shorts, people. You can call it luck all you want. There ain't no luck. I don't believe in luck. I position carefully. I wait, I pounce, and I go. I'm just happen to be short that stock, okay? There's others I'm short that I've covered. But right now, I'm actually scaling out of longs. Scaled out of Ball Corporation today. Blew out at 56. Done. All the way. Made 10 bucks. Done. I scale out when it gets overbought. I blow out and rotate money. So I'm out of Ball Corporation. I just started scaling out of Budweiser. I took some more Budweiser off today. A little bit. Not a lot. This is the rotations. I caught this down here for nothing. Low risk, high return. If you're not in the Genesis Cog, you better explain to me why. Okay, I'm just trying to like PR myself out there, but next week we'll talk about it. Things to throw out on the macro level today. Things to throw out on the macro level. I can't give away every trade, otherwise you'd never join the Genesis Cog. All the Genesis Cog trades are absolutely going gangbusters today. Literally today, we're up 2% overall in a market that's down 1%. And we got long and short, people. All right, lost patience. And if you don't get that joke, I cannot help you. Get it? Lost patience. Just replace the CE with the TS. You're going to tell me that inflation is under control. You're going to tell Blake Young. Blake estimates that the inflation rate is about a 3.7 handle. Blake, you're way too conservative. Way. But it went up from 0.2 to 2.7. Lies, lies, and more lies. Just lies. At least 800,000 Americans reported yesterday are opting out of Obamacare, which is a complete, utter disaster as healthcare costs soar. Keyword, forget about my opining and my obloviating and my agendizing on Obamacare. I opinionated. Forget that. The only thing that matters here are the last three words in that sentence. Healthcare costs soar. Healthcare costs are going through the roof. Just went to the dentist, got to go back for more treatments. We raised it 15%. I go, why? They looked around at each other and shrugged their shoulders. They don't know why. They can just do it because they want to. There ain't no supply and demand here, people. They're raising prices just because, well, they can, and they're not bringing them back down. That tells me the Fed is behind the curve. Sorry, Garrett, they're not going to cut. They're not cutting interest rates. Not. At least not now, they're not. If anything, they may have to reverse and raise interest rates, which will just blow Donald Trump's mind. So rising healthcare costs are the reason why the market's going down. Inflation out of control. Second, this comes from a quote from the Hunger Games. Remember the Hunger Games? May the odds be ever in your favor. Couldn't really fit the word ever before I go off the line, but I could have, right? May the odds be in your favor. Now, this is going to piss off Kaufman, and I do not want to piss off Don. It's never a good idea to piss off my boss. But yesterday, and he comes on once a month, and he's in like, what I call like post-retire. He's not even in retirement. It's what I call like para-retirement. He's not really retired because he doesn't work at the office, but he trades his own account because he's a trade junkie like all of us. I'm a trade junkie. So is Sosnoff. I've known Sosnoff for 20 years. He was my boss. I sat right across him. I flew on airplanes with the guy. I had dinner with him for years. I know Tom really well, okay? Know his kids, wife, whatever. Tom said yesterday on yahoofinance.com, and you can go view it, go pull it off the internet. He said, quote, and it was in quotations, a nasty sell-off in the market, okay, is in the offing. Quote, the word offing is something that I threw in to replace the other word, but he said in the next month or two, we're getting a nasty sell-off, okay? I'm never, ever agreeing with Sosnoff. We do not agree on anything. That's where Sosnoff and I connected. That's how I know we're right. We never agree, ever, so we can't be right. This one we agree on. So to me, we're on the same page. Sosnoff's reasoning was purely Don Kaufman logic. It wasn't about charts. It wasn't about fundamentals. It wasn't about politics. It wasn't about economics. Sosnov's entire argument was based upon risk-reward probability. How many times have I told you all? I built wealth not by intelligence. I just manage the risk. If you manage the risk correctly, you'll get rich. It's risk management that makes you rich. That's how it's done. It's not you stock picking. It's not you telling me, I know where it's going or buying the SP. That's not what it is. It's how you handle when things are bad and how you handle it when things are good. Okay? Sosnov said, quote, a nasty sell-off is coming. I'm warning you. When Sosnov makes that call, and he's not perma-bearish or perma-bullish, you should listen. Not because he's a technician and not because he's a fundamentalist. That's me. That's Brandon. That's Blake. You listen to the guy because he understands statistical probabilities better than any of us, with the exception of Kaufman. I'm telling all of you, the correction's coming. It's going to be a minimum of 1,000 points. It's going to be 10%, and you're going to be left behind. I can't pick the day. I just don't care. I want out when it's up. I got rich by selling high and buying low. I'm not waiting for the market to sell off and go, time to sell off. You've been warned, people. The odds are not in your favor to buy this market. Sosnov said it. I'm telling you. Last but not least, okay, I call it sticker shock. And if you can't get this pun, I'm literally going to walk out the door of this office and quit. This is a great, great pun. Sticker shock, like on a car. Get it? Shock as in getting shocked by touching an electrical amp, right? New York Power Commission, the city of New York, the administrators, the political leaders have said, quote, the data centers you're building in New York, because they're building them in Westchester, in upstate New York. They're not building them on Long Island. They're building them in areas above New York City. They're building data centers. They're going to have to pay more for power. Oh yeah, you're telling me this is like deflationary? People, you got to get a clue and stop with the news media. Just look at the facts. The facts, ma'am, like Sergeant Friday from the 50s. Just the facts, ma'am. The facts are healthcare costs are going up, power costs are going up. You know, I know power costs are going up because I just got my electricity bill and they were up 33%. Okay? Stop with the idea that telling me that inflation's good for the economy. It's not. What I call controlled inflation is this ain't controlled inflation, people. You're getting healthcare costs going up, raw materials, precious metals, and now you've got power going up. People, what do you spend most on? What, your mortgage? Got it. Food? That's going up. What else do you spend most on? Yeah, your electricity bills. Air conditioning for people in Arizona and Florida. Oh yeah? And heating bills and gas for people in Chicago and Minnesota. Get it? It's going up. They're going to raise the rates, and that's going to impact all of us. This idea that inflation's coming down is just an absolute lie. If you're going to bite into that crap sandwich that it's 2.7, I've got some swampland in Florida for you to buy that you can build on. Stop it. The market's going down. This will all play catch up. It's not going to crash. It's not going to go down 3,000 points. It's just going to correct to a degree, 10, 15%, and then settle in there. That's it. Now, individual rotations, and I pointed this out earlier. I threw this out, okay? I'm already short, and I am. Oh, look, we're down 72, never saw it. Told you. I have no idea where any of you are buying this. If you got to be buying this, if you work for me, I'd fire you. You're fired. Do not buy this. We could go down to 6,600. Don't buy on the way down. You buy on the way up, but we're now on the way down. What took it so long? God, man. All right. So here I am. I'm short Wells Fargo. I'm short a call spread, people. A defined call spread. I've effectively got about 21 from this Friday. So I've got let's say 16 days. All I need is for that to be below 88. I got 16 days. Get that below 88 on my 88.91 and I max out. I keep telling you, I have no idea why any of you are not a part of the Genesis Cog. It's not about me. The indicators are never wrong. Look at the rollover in the weekly. Forget the daily. The daily's useless. It's gonna basically log jam you. Look at the weekly. What's the weekly doing? I don't care about the buck 62. What's the weekly doing? The weekly. It's waterfall, which means the next leg down is a waterfall. Watch that stock drop $5 and then send me an email going, should have joined the Genesis Cog. I'm telling you, Don't buy on the way down. They don't predict. All they do is they show the path of least resistance. They show what the algorithms are doing in their spare time. And they're telling you the next support level is probably somewhere around 85, 84. At that point, you might revisit a buy. But if this is pointing the way down, you got zero chance of making money. You won't make a dime if this goes down. You have to short this. Trade with the algos, never trade against them, or you're going to learn a very, very painful lesson. Wells Fargo, I call Wells Fargon. Get the pun? Wells Fargon. I thought it was funny. Wells Fargon. Okay. Bad miss. Bad child. Bad bank. Bad miss. Okay. It's not a horrific miss. But I kept telling all of you, I'm a finance professor. I was an analyst. I still am an analyst. 35 years in the making. 35 years as an analyst. I was licensed as an analyst. I ran a hedge fund. I wrote articles. I'm printed everywhere. I keep telling you, I covered small cap financials, but I understand the footprint, how to price a bank. I've been telling you all, banks, when they're cheap, trade at a 10 multiple. When they're expensive and they're fully priced, they trade at a 15 multiple. How many of you listen to me? Probably zero. I told you, it doesn't matter what they report. They trade at a fully priced multiple. The stock is not going any higher. It was priced as if it's going higher. It can't. Even if they beat the number, it would have been beaten to death anyways. It's fully priced. To buy that stock, that multiple has to drop to 10. Then you go in and you back up the truck. Fundamentals matter. They don't matter in the short term. They're irrelevant. But in the long term, they determine the fate of your wealth, believe it or not. Next on the list. Next! Like I'm going to do a Don Kaufman on this one. All right. Squeeze play. Now, I don't have a position in either of these. I want to point that out. I'm not short either. I won't short them. I'm not going to step in and put my money where my mouth is and short these. Won't do it. Well, these are sacred cows. I'm totally uncomfortable shorting these. Totally. But just to throw this out at you, Gianni DiPocci's one smart little monkey. There is an absolute, I know it's down 5. I know. There's an absolute shortage of AI chips. There is a squeeze play going on. There are not enough chip companies who design and manufacture AI chips. There's actually not enough. There is a lack of supply of chip creators, AI chip creators and manufacturers, right? And there's excess demand. So if you're going to tell me you're going to short this, I'm not going to stop you. This may go way higher because nobody knows how to price this sucker. Should it be priced at 32 times earnings? Maybe. Should it be priced at 40? Maybe. I don't know. I was a semiconductor analyst for small cap semiconductor equipment, but this ain't equipment. This is chip design and chip manufacturing. So I'm telling you right now, I wouldn't buy this because it's too expensive, but I wouldn't call this a bubble. But I can tell you this, I wouldn't be surprised to see this go higher and DiPocci get it right. I would not. He's been calling for 400. I'm not going to challenge the guy. I'm just telling you, there's a shortage of AI chips, okay? And there's an oversupply, there's an overdemand for this. So even though this may come into 300 and correct, it may not stay there very long. It could reverse. I'm not sure this is fully priced, but this and Advanced Micro are the two largest manufacturers in the world of AI chips. For that very reason, I won't short them. I won't even think of shorting them, okay? Advanced Micro is a little bit pricier at 100 times earnings, but they have the head start on Micron. So if you don't own these, okay, here is what I suggest. Don't buy them here. Wait until they crash, like I do and DiPocci does. When they crash, you go in and buy them. Don't buy them here. You don't know where the top is because you can't price them. But this, to me, is an opportunity that if this comes well below to 100, I'm backing up the truck and loading up on AMD just simply because the supply and demand equation is in my favor. I'm bullish on these. Won't short them, won't buy them just yet. Throwing this up there. Number 3, breakdown dead ahead. Any of you Boz Scaggs fans? I'm a huge Boz Scaggs fan. He actually lives in Las Vegas right now. Every now and then he comes out and does the scene in Las Vegas. Love Boss Gags. Lido Shuffle, Lowdown, Breakdown, Dead Ahead's one of his songs. People, Rivian got a problem. Now, I live in Chicago, and Rivian is everywhere. I see Rivian trucks everywhere. I'm not picking on Rivian. This is not a moratorium on Rivian. I don't hate Rivian. I don't. Okay, it's an interesting little truck. I think it's an electronic truck. But Rivian got the death knell today. Got a death sentence today. And if you're asking me, well, what's a death sentence? Been in the business almost, this is my 39th year. Look how old gray I am. This is a death sentence. Rivian was cut to a sell. Now you see that weekly rolling over? If I were you and I own this, liquidate it. Don't you dare buy a put. How dare you? Liquidate all of it. All of it. It's unanimous. A number of brokers came out today. They cut it to a sell. It's a death knell. Now, if they cut it to a sell at 9, load the boat and buy it because it's already priced in. This is really close to its high. So if you think I'm late to the trade, you just caught it. The MACD is never wrong. You are. Look at the MACD starting to gain traction. The only concern is you've got earnings on the 12th. Now that's 4 weeks from today. You have earnings 4 weeks from today. So you have an opportunity to make money in this stock. If you own it, liquidate it. If you own it, hedge it. If you're not short, you can walk in and throw your hat in the ring and say, I'm going to buy a put, but it's down 8%. Don't care. They put a sell on it and their target price is $11. Oh. People, I keep telling you, how much money have they made? Numbers never lie. CNBC guests lie all the time. Don't lie. Look at the numbers. Minus 96 cents. Oh, they're a really rich company. They've never made any money. Why do you own it? They're broke. Without financing and debt financing, they're broke. If they don't have GM walk in and buy them out, they're going under. They will. You can't survive without making money. AI makes money. Micron does. Even Wells Fargo makes a lot of money. They don't make any money. They've never made money. These analysts should get a bonus. I am really down on analysts. I can't stand you. You guys stink. You are March of the Penguins, but that's a good call. It's a good call simply because you cannot explain to me or conflate to me why this stock is priced here. They don't make any money. They've never shown any progress towards making money. Period. I don't care about the sales. I don't care if they make $5 billion in sales. If they lose $5 billion in a penny, they're a worthless company to me. The whole point is to be profitable. Look at the stock, trade away at your own risk. I personally think trading low, UBS downgraded him. UBS is now on my respected list. Raymond James, get out of here. You know, always bullish. Jeffries, perma bullish. Can't take it. Give me a bearish call and you get my respect. I want a two-sided market. That's a great call. That stock's not even worth 11. Go look at the book value. Book value doesn't lie. That stock's worth $4.13. Period. End of story. I wouldn't buy it until it hit $4. Last but not least, I don't like sugarcoat anything. I just tell the truth. And if you don't like it, great. I'm too old to care. All right, next on here. Shanghai Surprise. Well, this one caught me by surprise. That's why I'm calling it Shanghai Surprise. I have actually never heard of this company. Never heard of them. Never. Does that matter? No. This particular bullet point ain't about this company. You're like, it isn't? No. This company is a poster child for your account. Okay. It's at an all-time high. Me buy. Me grunt. High buy. Okay. Let me explain something to you. This company is being investigated by the Chinese government because it's a Chinese ADR. It copies, quote unquote, Expedia. This is the Expedia of China. It's the TripAdvisor of China. Get it? Okay. It's kayak.com, China style. Get it? The surprise came out when they're being investigated for anti-competitive behavior. They are a monopoly and they are price fixing and they are cooking their books and they are misquoting. Read the update. It's an antitrust probe into trip.com. It is a Chinese company. Now, here's the thing. I don't even care about the earnings. It's not about profitability. It's about, this is the lesson I'm going to impart to you and move on to this and move on to the volatility. So listen up, okay? Listen to a guy who's lost millions, who has basically ADHD, and I'm an idiot savant. I've been through hell and heaven in this business, okay? And I learned this importantly through my dad, God rest his soul, my grandmother. When the market is up, I know you write this down. Get out! Why are you waiting for things to get better? This stock should have been sold regardless of the fact they're being investigated. If you own this stock and you didn't sell it and you worked for me or you didn't hedge, you can consider yourself fired. People, the whole point of the business is simply to buy low and sell high. Protect your wealth. Protect it. I build it, I protect it. That's what I do. That's my strength. I don't make home runs like Gianni or Corey. They're way better traders. I just make money and keep it. And when the market gets slammed down 1,000, I'm be making money no matter what because I'm playing both directions. I'm just telling you, this isn't about the antitrust behavior. This is about you're looking for a reason to sell. By the time you find the reason to sell, that's what it looks like. That's what it looks like. Now, I'm not telling you to buy this or short it. I'm just telling you, go across your entire portfolio, every stock you own, Parabolic, AppLovin, Palantir. Don't look for a reason why you think it's going higher. If it's massively overbought, you don't need to even sell it. You don't even need to buy it. Just hedge it. Play to protect when you're ahead like a football team. And when you're behind, play to cut losses and protect as well. That's what we do best at the Genesis Cog. We just come up and say, bad trade, bad Jeffrey, take the loss. But when we have big gains, we protect them. That's why I sold Cheesecake. That's why I sold Ball. Every time I make a ton of money, 20, 30%, I get out of the trade and move on. I'm not going to do this because if I do this, Genesis Cog will have 0 members. That's the lesson you learn. All right. Last but not least, today, okay, from the current slide and below, we're going to talk about the cons, the bad news, the disadvantages, what I call the grifting, the misappropriation, the mistakes people make of low volatility stocks. Now, again, the Genesis Cog is split right now. We've got about 67% to 65% low vol stocks. By definition, low vol means that the beta is less than 0.75. The average beta is about a 0.65. We've got some betas greater than 1, some betas greater than 1.2. We split the difference. We're out there. But a lot of you think like, well, I've got to diversify like Bierman. He doesn't like my AppLovin. No, I don't. But that doesn't mean I'd short it. I just wouldn't buy it because I don't want to take the ride down. I'm too old to lose money. Okay, I'm not young like a lot of you. I build wealth and I keep it. That's my goal. Remember I told you Shaquille O'Neal's famous saying is, he's my favorite like guru in money. They said, Shaquille, how much are you worth? 500 million, 400 million? He wouldn't reveal. But he did say this on TV one day in an interview. He said, it's not how much money I make, people. It's how much I keep. Exactly. If you want to keep money, stay with me. You want to lose money? Roll the dice. Diversification. A lot of you think, well, man, I'm just going to go Bierman's way and go low beta stocks, low vol stocks. Be careful. Be very careful. There are a lot of drawdowns from this. There are things that could go haywire against you, and you have to fight against it, and you have to be tuned in to understand what I'm talking about. You're thinking it's diversification, which is a way of reducing risk, okay, by adding more stocks, okay? That's the lazy man's way of looking at it. It's not. The real way is looking at the correlation factor, which I'll talk about. A lot of you diversify. You go in, you listen to me, you say, I'm going to go in and buy those crummy stocks that Bierman buys that suck, that are boring, but your timing stinks. Your timing is off, or you buy something low vol and you're like, oh, it went lower. Bierman sucks. His low vol stuff doesn't work. No, it doesn't work for you. It works for me because you commit sins. You want to know one of the sins you commit? Okay, and we'll get to that. It's overvaluation potential. So here is one of the crappy parts of the low vol, okay? You have to expect low returns when you buy low beta stocks. Like you have to sit there from day one and say, all right, I need to make X amount of money. And you pressurize yourself. And I get emails all the time. And I love the Genesis Cog members. They send me emails. I want to make 100%. You're not. I want to be able to double my money in a year. You're not. You're not. Not with low vol stocks, you won't. With high vol, you might. But if you're wrong, it's the point of no return where you're never going to come back in the business. So you got to be really careful how you do this. You know, it's like a surgeon. The idea here is, the fact of the matter is, you have to accept the fact that low vol stocks, while they may make you good money and they do well for me, they tend to have low returns, okay, in all types of markets, especially in economic booms. So while you're thinking to yourself, like, I'm out there and I'm loving it and I'm loading the boat on Intel, and you own a big position in Intel, and I give you all credit. I give a lot of you due credit. You own Intel, good for you. You're doing great. You're looking good. You're feeling good, Lewis. Looking good, Lewis. It's good. Nothing wrong with that. Like, I won't buy Intel because it's expensive. I also never short on the way up. That's why I don't lose money. We don't short on the way up. That's up. Look, it's up. Forget it. It's got to turn down to short it. Okay. I'm trading with the algos, not against them. But this is what I want to throw out. Okay. This is a high beta stock. It's a high vol stock. Can it be low vol at times? Sure. But the thing you have to understand about low vol stocks is during economic downturns, they tend to outperform high beta stocks, high vol stocks. It's just a fact. So let me show you what the Genesis Cog owns. I'm not going to give you every one. Okay. This is Genesis Cog stock. We own this at 72. And we're starting to really kind of put the jets on and make some decent money. I own it over here. Okay. So I'm up about $5. It's nothing to brag about. Not a lot of money. It's not even 10%. Okay. This stock tends to perform well when the market starts to roll over. So let's just put this in perspective. I'm going to go over here. I'm going to change the style to a line. Okay. And I'm going to bring up a comparison chart. So I'm going to bring up a comparison chart to the S&P 500. So while the S&P is ripping, look what this stock's doing. It's not making any money. It's not. It's actually, you're losing. I'm going to buy a low beta. So you go in, you pay 70, 80 bucks for it, and it drops down to 73. Then you curse me, you send me a hate letter and threaten my family and go, I hate that guy. Because you bought it there. You bought it in September when the market's breaking way into the fourth quarter. You bought it at the wrong time. But here's the thing. This is not, quote unquote, an economic correction or a contraction. You bought it when the market's booming. So what you did was you committed the ultimate Bierman sin. You bought it when the market's running. That's not when you buy it. You buy it when the market's rolling over. You miss the rotation. That's your problem. Get it? The idea here is the bad part about this is you think you're buying it because it's low vol, but it depends where you are in the market cycle. You're buying it when the market's on the way up. That's why you're losing money. For me, I buy it when the market's on the way down or peaking because I'm playing what's called the economic boom lag. But here's the bad part about it. When this rallies and the market starts bottoming out, let's say the S&P bottoms out at like 6,000. You got to get out of this. Get out, Rock. Get out, Rock. You sell this for two reasons. It's fully priced at that point. It's made the run it's going to make the entire year. It's already made its $10. All you're going for is $10. $10 is 12 to 15%. That's what you're going for. And if you're doing an option, you could still make 200-300% on the option. You could, if you timed it right. Selling a put spread, buying a call, you could. But the idea here is the bad part about this stock, and I know it, and I have to be perfect or the Genesis Cog members are going to just scream at me. You have to time it just right. You got to buy it when it's cheap, when it's oversold, and when it starts to become an economic, quote unquote, the economy starts to roll over. But the bad part is you're going to sit there and tell me, oh, it's an 83. I'm not going to sell it. And you're going to lose all your money. You're going to give it all back because you don't understand. While it rescues you in an economic correction, it destroys you in an economic boom. I call it, and this is my term, I call it the economic boom lag. It lags while the market's booming, tech, financials, it's not going up. You don't have to tell me. I used to come in every single day to Genesis Cog members. Florida Woody, John Fleck, they never picked on me. Bart F. Every day I tell Bart, hey, Bart, I told him it's not going up. Every day I tell him, when's it going to go? I said, it's going to go up when we hit January, mid-January. How perfect is my timing? You can argue with me? I told you, you have to understand the mechanics of low vol stocks. That's what I understand. I don't know how high this is going to go. I don't. I know one thing. I know how low that's going to go. That's what you're paying me for. You're paying me to tell you how low that's going to go. I don't know how high or low the S&P is going to go because I don't know how to price it. Nobody does. It's a joke. All it does is it reflects the broader market and what you think is the economy, which it may or may not. But when this corrects, that's going up. That's what I know. But when this goes up, I have to get out. So you have to be aware. The good side is it protects you against, it's a hedge against an economic downturn. Yes. The con is that in an economic boom, it penalizes your portfolio. You're going to underperform. There's no two ways about it. And if it does go up for whatever buying reason, for value, or somebody sees something in it, a takeover, an upgrade, it's never going to make you as much money as another stock. It won't. You're not going to make as much money as Intel, Palantir, Roblox, AppLovin, Meta, CoreWeave. You're never, ever going to make as much money on a low vol stock. You have no shot. I know that. That's the con. You have low returns. They're built in to be low returns. But the thing is, I'm not an investor, TheoTRADE members. I'm not. You might be. I'm not. I'm a trader. So I get in, which I did. I got out. I made $10. And now I'm back in again and going to make another 10 is my goal. So while you're looking at something that's high flying, I'm not. I'm looking at trading ranges. That's how I built my wealth. I build wealth on ranges. Low risk, high return. I hit the pill, I go to bed at night. How many of you can say that? I bet it's pretty much zero. If you join the Genesis Cog, you'd be sitting there going, oh my God, I'm making money. And now I can go hang out and not look at my screen. Exactly. I don't sit here and worry about every trade. I never do. All I do is I identify risk reward. I picked really good low vol stocks to pepper the infield. They're not all low. I've got high vol, I got average vol, okay, stocks. I just pick low vol stocks because it's my strength. And if there's one thing you'll ever learn from Kaufman, Kaufman's a genius teacher. And this is what they told me years ago. And Frank Walsh taught me, good old Frankie. They always used to say, play to your strengths. Trade what you know what you trade. I just play to my strengths. Former hedge fund guy, understand all kinds of volatilities. What's my strength? It's always been low vol stocks. I've made a killing on them. And that's what I do. But the fact of the matter is, it's not the answer. It's not going to work 100% of the time. It's flawed. Everything's flawed. So don't just think for yourself, I'm going to diversify by buying low vol. You could blow your portfolio out if you buy at the wrong time and you don't recognize the economic boom bust lag. That's a fact. The next one on here is this, okay? Overvaluation potential. I have said this time and again. You can't play the one-size-fits-all game. It does not work. Stop. People ask me, well, shouldn't I just go in and buy what you're buying? Nope. You just can't buy anything in that sector. It won't work. You have to buy what is cheap. If you do not buy what is cheap, you'll get your ass kicked. I've said it time and again. Don't buy this stock. I don't care. It's trading at an obscene valuation. That stock should not be trading one multiple of a handle above 50. Even a 15 is a push. This stock cannot grow and will never, ever grow as fast or as on a compound annual growth rate as Wells Fargo, JP Morgan, Goldman Sachs, anything, nothing. But this stock continually trades because it's Coke. It's Coke. So people keep buying this. I keep warning you. You think you're going to go and buy and you're going to play the Bierman low vol game. And then you come back at me and you're like, send me a vituperative angry letter. You said if I buy on the rotations. No, you can't buy anything. You got to buy what's cheap. And the overvaluation potential, it's there. This can't go up very far. It can't. Its valuation metric is prohibitive. It won't. It might go to 73, 74. It'll get to 25 times earnings. And every single value manager out there is like, we're done. And they'll wash their hands and get rid of it. They'll be done with it. You have to buy what is cheap on the low vol side, or you can't play the game with me. Overvaluation potential is remarkably, it just sits you and stares you in the face. It may be perceived as safety. Oh, the market's down 64. Oh no, it's down 500. Bierman and Kaufman were right. Gianni's wrong. It doesn't matter. That's not going to make it go up. That's not why it's going up. It goes up because it represents safety and it's cheap. That ain't cheap. When I went in and said, all right, I'm going to walk in here and buy Kroger. Why am I making money, people? By the way, that PE multiple is deadly wrong. And I got an email from one of our members saying, you're right, Bierman, the PEs are often wrong. I know they are. You could AI co-pilot it, you could Gemini it, and ask what the multiple is. The multiples on half these stocks are simply wrong. The multiple on that stock is a 14. I've crunched it a dozen times. 14. Insiders are buying. Why do I own it? Because it's cheap. Because they make money. Because they pay me a dividend. If that were paid, if that were at 25 times earnings, I wouldn't own it. I wouldn't own it. There's no point. No point in owning it because I can't get any leverage on it. I don't buy because of the chart. That's the mistake a lot of you do. That's why you get so badly burned, a lot of you. Don't buy because of the chart. You buy because it's cheap and it's going higher. So if you come at me and say, well, it looks like I'm going to buy AppLovin because it's going higher, but is it cheap? But is it cheap? Because if it ain't cheap, it won't go that much higher. It'll eventually hit its level, and pivot, and come back down and burn you. Don't overpay for anything, whether you're a growth or value manager. I just don't care. Don't overpay for anything. Anything. So know how to value. I don't know how to value. Then join the Genesis Cog Mastermind. I will teach you. It's a 12-week course. Again, we're doing a program webinar next Wednesday, a week ago from today, with Don Kaufman as the Master of Ceremonies. I got a slide deck I built. I'm going to show you how the machines work and why you keep losing money, why you keep fighting these. You keep arguing it's technically driven. It is, because the machines are technically driven. But when things start to go down, money managers who control the wealth are not going to buy it on the way. They just don't buy on the way down. You do, they don't. They buy when what? When it bottoms out and they feel it's compelling value. These value people and some of the growth people. So don't tell me you're buying because it's defensive. I look at a lot of these stocks. Here's another one for you. Let me give you another defensive stock. You want to see another defensive stock? I'll lay this out. People say, I'm going to go and load up on Pepsi. Okay, it's up $2 today. Would I buy it? No. Why won't you buy it? It fits your criteria for defensive. Look at the multiple. Look at the multiple. That multiple is right. It's about 25, 26 times earnings. I'm not buying a stock at 25 times earnings. You, go ahead and you do it. But if Pepsi misses by a penny, that stock's down $40. I can't take a $40 hit, can you? They'll destroy that company. They'll gap it down $40. They will. That multiple could compress down to 10. You don't think so? I know so. Want me to prove it to you? I'm the idiot who went and bought General Mills, and I just don't give a crap. You can come at me and fire me. I'm not going to sell a stock at 10 times earnings. You're out of your mind. That stock could be bought out. They can report a crappy quarter. It won't matter to me. Their long-term multiple has always been 14 to 20 for about 60 years. I just don't care. I own the stock because it's cheap, it's defensive, it pays me a massive dividend. So however long it takes to get up there, Jimmy Crack Corn and I don't care because I'm not a money manager who has to play the beauty contest game. Financial porn, I don't care what the chart looks like. I just buy what's cheap and I sell what's expensive, or I sell what's fully priced. That's what I do. Or I short what's really expensive. That's how I do it. And how do I do it? I've been doing this since I came out of my mother's womb. I was trained by portfolio managers across the country who wrote books. Marty Zweig. I was lucky enough to meet the guy. He's a patient of my dad's. I used to watch Louis Rukeyser, read David Dreaman's books. Most of you have never spent a day learning fundamentals. It's not a bad thing, but it leaves a hole in your resume. I know how to price these accordingly, and I can do it across a spectrum of different metrics. It's an edge I have. That's why people come to the Genesis Cog, because I can advise you what's high risk and what's moderate risk. But be careful of the potential for overvaluation. Everybody thinks because, oh my God, it's like a play in stock. It's defensive. It fits that defensive profile. It's cheap. You could get your ass kicked. You get whipped, blow your account out on stocks. Want to bet? I'm the guy who got short Campbell's Soup. I did. I got short Campbell's Soup 3 years ago, and that was over here. That's me, people. The stock was trading at 32 times earnings. And I kept saying all the time, and I was at one point on Kelly Evans you can go look it up, Google my name on CNBC. What does Bierman hate? I kept saying, short all of the consumer staples. They're priced like internet stocks. Was I right? People, it took what? Look at it. It's on a 52-week low. Look at it. It can't gain any traction. Why? Because there's no growth. Zero. And I'm not going to pay zero growth for a stock at a 13 handle. If that stock goes below to an 8 handle, I might buy it because now it's in play to be bought out, merge, or at the worst case, I buy it at book value and I get a 7% yield. The yield just doesn't matter. I told you this. You don't buy for the yield because if you bought for the yield, you blew out your account. You'd be fired on Wall Street. Oh, I bought some Mr. Jones Campbell's Soup because it was paying 5%. And you got fired the next day because the stock can't gain any traction. I'm not going to buy this. I'm not going to buy it at any price. It's just not cheap enough. That's why you come to me. I'll let you know when it's a good buy. Technically, it looks like crap, and that's not why you buy. And you don't buy on the way down. You buy when it bottoms out. So when I buy when it bottoms out, and it turns, and I get the algos to defend me, and then money managers then piggyback off of my knowledge of fundamentals and go with it and run it. But I don't do anything haphazardly. Don't play the game of a one-size-fits-all and think that every single defensive low-vol stock is cheap. They're not. Half are cheap, half are ridiculously still expensive. They're ridiculously expensive. The last one on here, okay, is diversification risk correlation factor. I keep telling you, people define diversification as, well, instead of owning 2 stocks, I own 20. Technically speaking, based upon the statistical model of the probability density function and the quote on the t-test and the p-test and the degrees of freedom, you need at least 20 stocks in your portfolio to be considered academically, technically diversified. 20. Write that down, TheoTRADers. 20. Do you have less than 20? You're not diversified. But if you have more than 35 to 40, you're no longer diversified. You're diversified. So there's a sweet spot for diversification when it comes to number of holdings. The minimum should be 20, the maximum should be 40, the average should be 30. That should be it. At 30, you're done. Now, right now, the Genesis Cog has got about 22. We're right in that sweet spot of diversification. We've got long, we've got short. This implies that everybody's on the same side of the trade, which means they're all long. So the more stocks you add to the long side, you reduce the standard deviation, but you also reduce the compounded annual return. It's a fact. But at some point, when you add too many stocks, okay, you don't diversify, you actually diversify. You actually penalize your portfolio and you actually lose money. You're like, hey, wait a second. I added 15 stocks and now I'm actually going from making 20% to losing money. You added too many stocks that underperform and you've got it all wrong. The idea here is it's the correlation factor that makes you rich. The correlation factor. So if you're out there, here's one of the cons that people make. It's a mistake that people make. Bring up the correlation factor. Here's the correlation on the S&P. I'm going to use weekly, 10-day weekly S&P, the correlation factor. Okay, I'm going to convert this back to a chart type of a candle, and I'm going to show you this. So what I'm telling you is, okay, at this point, while the S&P goes higher, Campbell's Soup goes in the opposite direction 83% of the time. It's got a negative 0.83, which means every time the S&P goes up, Campbell's Soup goes down 85% of the time. So every time the S&P goes up and you own Campbell's Soup, you're going to lose money. Congratulations, genius. That's not in your favor. What you need to do is you need to understand how diversification works. Most people are taught diversification is a number of holdings. That's true, but that's not the key diversification. Key diversification is asset allocation via correlation. That's what I can bring. That's what, like, good night, I retire from Theo. That's how you get rich. You have to understand how correlations work because they help you manage risk. All you're doing is you're not predicting. You're just sitting there going, okay, what are the movements? What are the probabilities of movements? That's how Kaufman teaches. He's brilliant. If you can figure out probability movements, you can pyramid and get so stupid wealthy you have no idea. Try not to fight these correlations. So right now, I'm looking at this, and I look at something like Intel. Now, Intel's making a run. Its correlation's 0.67. Example, there's diversification. There's a 33% diversification. There's actually diversification in that holding. He's long. You're long while the S&P is going down. That's okay. Nothing wrong with that. Nothing wrong with that at all. Going long while the S&P is down. Ain't nothing wrong with that. But you need to have a form of what I call correlation breaking away. So you need a correlation somewhere 0.25, even negative. Because if the S&P drops, everything you own that's low beta can actually move higher. So if you're wondering, like, why at this point is Bierman starting to make money on SYY? Because the correlation factor is, as the S&P drops, okay, I'm disconnected. If the S&P drops, my SYY is going up. Now, if that SYY goes to 0.5 or higher, I can't make any money. I won't make a dime, not even a penny. Because what will happen at that point is, once they're correlated, okay, what will often happen is they will break correlation. They'll break correlation, which means when this gets fully priced up to about 83, 85, which is my target price, this will automatically hit a 0.5 to a 0.7. And it's like, uh-oh, if the S&P turns about, let's say the S&P goes to 6,000 or under, and then reverses up, that stock's going to get killed. They're going to blow out of that like it's cancer. It'll roll over in 5 minutes, give back everything I made after a month. Easy. You have to time it just right. They're buying this because it's low vol, it's safety, it pays a dividend, it's in a defensive sector, it's a hedge against the market going down, stable cash flow, people have to eat even when there's turbulent times. All the psychology, the characteristics, the narrative, they're there in the footprint. But that doesn't mean I'm going to make money forever. You can't be an investor in this. You won't make any money. You will not make a dime if you invest in this. Because if you bought this 5 years ago, you made no money. You have to time it just right. That's what you pay me to do. I tell you, in the Genesis Cog, this is where you buy, this is where you sell. Get out, next trade. So I rotate constantly, but I don't put a trade in every day. But right now, I had about 14 longs. I'm down to about 10. I've got about 11 or 12 shorts. I'm starting to scale out. Okay, Wells Fargo is one of them. They're starting to break down. The correlation factor helps you identify the timing sequence and the directional movement. So as this moves higher, it's still diversification. But if this gets directly to a 1.0 and you're thinking, well, they're log jammed today at 1.0. No, you're thinking that's going to go higher. You won't. They will break that correlation because low vol stocks are inversely correlated to high vol products. That's what you learn. So as soon as they start bottoming tech and financials, you got to bail on that. Move out. Move on out, people. Move, like, Billy Joel, moving on out. You got to get out. And then let it drop back down and then buy it back again when the time is right. That's how I'm positioned. Why is my account up 2% today? Well, the market's down 1%. I just rotated ahead of schedule. I looked at the correlations. I looked at the low vol stocks. I looked at the seasonality. I looked at the values. Everything matters. Adele, everything matters. She sent me an email. What matters to you most? Everything. I watch every piece of data and I plug my ears on CNBC people because they only know one thing. Buy at any price. I don't buy at any price. I buy what's cheap. I sell what's expensive. And I watch the rotations and the correlations very carefully. All I ask is that you give patient and trust me, and we can make money together. And we're doing it beautifully with low stress. Now, you come back tomorrow. We're going to finish out the cons. There are cons. There are other reasons why low vol stocks can actually turn out to penalize, hurt you, make you lose money, make you underperform, exasperate you, and just like, I'm never going to do this. No, don't say never. Just get the strategy and the sequence down right, and I'll teach you how to do this. In the meantime, I think Brandon Chapman's coming up here. I actually have to go outside and fight. I have to go to CVS to pick up my wife something. It's got 3 inches of snow out there and 22 degrees. It's like a whiteout. You think I want to sit outside? Oh, hell no. Hell nah. So that's going to conclude the lesson today. I hope this has been value added. I'm sorry for being like a pedantic, doting father, but the only way to get through to you is to tell you straight out. I got to be cruel to be kind. I got to tell you straight out. You can't just simply buy every dip. It's going to cost you eventually. There's no free lunch in this business. I can't predict every tick of every moment. I don't even try. All I know is if I get the risk down, I don't got to worry day to day. I don't sit here and go, ah. Day to day never bothers me. I lose 3 days in a row. It just takes one day to restore confidence. And the Genesis Cog people, they're sitting there going, they're just banking. All their memberships have been paid for. The last 2 days, their memberships are completely paid for. I just said, trust me, middle of January, I will convince you. Okay. On that note, I'm going to let Brandon Chapman take this with it. I'm dressed in my my sweater. This is actually from the Aran Islands from Scotland. Not Scotland, Perrine, from Ireland. I went to Ireland. I didn't get to the Aran Islands, but I bought an Aran Islands sweater. Beautiful. Great. Like the best wool in the world. Not quite cashmere, although I do have a cashmere from Scotland. And I'll let it roll through. Brandon, whiteout today in Chicago. Complete whiteout. I'm driving on the road, can't see 1 foot in front of me. Literally. We had 3 inches of snow and fog. What's it like in Salt Lake City?
Yesterday it was in the 40s. It's gonna be in the 40s all week. It's look, I mean, I get it. Sometimes we have warm La Nina years. We usually get late snow. The Olympic year, 2002, we had no snow until 2 weeks before the Olympics, and it just dumped on us. So there's plenty of snow for the Olympics. And the problem was I work for the host broadcaster. We show up at Soldier Hollow where they do the biathlon and cross country events. They didn't map out the lines because it hadn't snowed. And so also we get there and they didn't map out where all the lines were going. We had to run new lines. I'm digging through the track in the middle of the night, trying to lay stuff down. So I want to have a good snow. I want to have walk out, have 10 or 12 inches at least once or twice this year. I don't know. I don't know if we're going to get it.
All right. Well, I'm going to let you roll with this. Brandon, today the Genesis Cog portfolio overall is up 2% on a down day of 1%. And we are split evenly between short and longs in every single trade, every single position. There's like 15, 16 today, big ones. They're all working. It's a whitewash. So this has been a really good day. All I did, Brandon, was I played the rotations. I said the market's going to correct in January to February. I didn't time the day or the hour. That's not what I did. I just picked the range. I followed the protocol. I managed the risk. And it pays off. And Brandon, I learned a lot from you how to manage, because what I do now is after I take a position, I run immediately to look at the volume and the open interest on the spread to make sure that I don't get it wrong. That's what you taught me, to look at the actual volume of the spread, because it will give you an edge, and it actually does.
All right, great. I'll have a good. I like the sweater though.
Yeah, thanks. I appreciate it. You have a great day in Salt Lake City.